Hey, Brad Bob here, and I want to talk about an exciting thing for federal employees. That is the TSP, Thrift Savings Plan, and investing in the TSP. All right, something that people are always asking questions about, always concerned about. So, what I want to discuss today is what you're investing in your TSP, and more specifically, investing in the C Fund, S Fund versus the I Fund. Okay, one thing I've heard a lot of, and more recently here in the last couple of years, is nobody should ever invest in the I Fund. Nobody should ever put any money in the I Fund. I hear that and I think that's crazy. Why? And the answer is always it doesn't. The returns aren't as good, and they have a good point if you want to look at the last 10 to 20 years. Okay. Recency bias is what it's known as. So the C Fund has done the best over the last decade, and really even longer than that. I'd say the past 14 years or so, the I Fund has done the best. And if we want to look at that, we can look at numbers right here. Okay, just go to tsp.gov and you can see numbers. So C Fund past 10 years 12.8%, I Fund 4.46. All right. Big difference. I get it. But does that mean you shouldn't invest any money in the I Fund going forward? And I would argue no. You can get a lot of data from what's happened in the past, but just because one fund has done better in the past doesn't mean it's going to do the best over the next 10 years. So I read an article recently, and I'm always looking at data. I find it interesting on stock markets, investing. This is an article that Savant Wealth did here recently, and but yet the charts that they have came from somewhere else. Okay, so they're taking data here from Schiller for this chart, but right here, what they're saying is when it comes to investing, that there's three things, three components that determines your returns. That's earnings growth, dividends, and valuation changes. Valuation changes are saying, i.e. expansion or contraction of the PE multiple, which is price to earnings. Okay? And in this, it just talks about research here from O'Shaughnessy Asset Management. Basically, that PE multiple growth, valuation changes or PE multiple growth has a much bigger impact over the shorter term, so a 5 to 10, 20-year time period, versus you go back to 1987, 150 years you're looking at. Then you can see the dark blue here, 0.51% is the PE multiple, very little impact. But if you look at 1965 to 82, a shorter time period, 17 years, it had a 3% impact. You look here from 11 to 21, it had a 3.5% impact. Okay, and really, the argument that they're making is the lower the PE multiple is, the better the chances of making money in that investment over the next 5, 10, 20 years. Okay, the higher it is, then the smaller the return expectations over the next 5 to 10 years. So if we want to, let's scroll down here and look at the table. And they talked about other things like dividend, earnings growth and dividends. So you can see that stuff right here too. Dividends is the light blue, earnings growth is shaded gray. And earnings growth tends to be the biggest component. However, if you look over here, dividends are actually larger over that 150-year time period. More recently, earnings growth tends to drive returns. So, in this chart here, just talks about PE ratios, the discount of PE ratios from international stocks compared to U.S. stocks, and we're at a significant discount right now. And then this chart here talks about difference in dividend yield. Okay. Dividend yield, when it's higher, then you have higher return expectations looking forward. Dividend yields higher for international stocks right now. And if we go down here to look at this table, I find this table pretty interesting. So we got your S&P 500 here, so basically your C fund. And then we've got your international stock market index here, like your I fund. And then over here is emerging markets. And then this last one is international small cap, okay? So you don't have access to emerging markets in your TSP. You don't have access to international small cap in your TSP. So these are things that you would have to get outside of your TSP. But if we look at these, the lower the PE ratio, the better when you're looking at future earnings potential, okay? So PE ratio, C fund right now, 18.2. Okay, that's historically that's 53%. And really the higher this number, you want this number to be lower, okay? So the higher it is, the lower return expectations are over the next decade. The lower that number is, like a 4 here, the higher return expectations are over the next decade. And that's what they're saying here. They're saying that there's room for PE expansion, room for PE growth, okay? Which means price would have to go up to have a higher PE ratio. So international stocks, you're looking at 4%, the top 4%. And then you can see the numbers here. You've got price to earnings, price to book, price to sales, price to cash flow, and then earnings numbers down here. And they're all consistent. They're higher for US and then much lower for international, emerging markets, and international small cap stocks. So as far as the PE multiple goes for returns, that component of returns, that looks much, going back to this chart here, it looks much better for international stocks, emerging markets stocks, and international small cap. And as we can see here, it looks better for, when it comes down to dividends, that looks better for international stocks as well. Now, one other thing they talk about here. So they also talk about, it says 2 ways to potentially win. When it comes to, I'm not going to get into that much, but you also have currency, differences in currency. So the dollar strengthening or weakening versus other currencies. And I'm not going to get into details there, but basically their argument is that looks beneficial for international emerging market stocks going forward as well. Now look at one other thing that they discuss, and that is reversion to the mean, and how one geographic area can outperform for a period of time and even a long period of time, and then another one tends to take over and outperform for a period of time. So this is a chart here from JP Morgan, and it just shows, it shows different periods of outperformance for international stocks and different periods for US stocks. So the gray, and these colors are so close together, I don't know why, but the gray is US outperformance, the purple is international outperformance, all right? And you can see here at the top, the outperformance 374%, and in the period of time, 6.1 years. Well, I mean, you see here, international has a long period of outperformance than the US. Okay, it switches the US, and they have 4.2 years of outperformance. Then international for a short period of time, then US again. Okay, most recent, we've got US outperformance of 210% over a 15-year time period. Okay, and looking at these other time periods, that's pretty significant. So one of their arguments, I believe, was reversion to the mean, that eventually this is going to turn to where we're going to have international outperformance. Now, who knows when that's going to happen? There's no guarantee that it will happen. In investing, there are no guarantees. So what I want you to take away from here is this: do not ignore the I fund, okay? And most importantly, recency bias. So just because a fund, just because an investment has done better than another investment over the past year, past 5 years, past 10 years, does not mean it's going to do better over the next year, 5 years, or 10 years. All right. So by no means is this meant to be an investment recommendation, but what it is meant to do is to get you to think a little bit, okay? That just because the C fund has done better over the past, 5, 10, 20 years, does not mean it's going to do better over the next 5 to 10, 20 years, okay? So think about that when deciding on your TSP allocation and invest accordingly, all right? And hey, in the comments, I'd love to hear from you. Tell me what your thoughts are. Is this something you've looked at? Are you investing just in the C fund? Just in the I fund? Are you allocating to both? And why? Okay. Love to hear what others are doing. Thanks.